From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB, all the stuff you need to know in the day in business and finance. I'm Carl Water and I'm with Juliet Saleh, of course. Juliet, it looks like a pretty positive day. A lot going on in the earnings front, but I have a feeling that we have a certain company in the United States to thank for that.
Yes, indeed. Nvidia, the chip maker, and it's all about AI as well, absolutely beating the street with about $2 billion more in quarterly revenue than what the market was looking for. So that has certainly seen shares soar in after hours trade. And of course, the company's CFO as well on the analyst call basically saying, look, there is just still so much demand. And in fact, they're more concerned about trying to meet the demand rather than the fact that there'd be a supply shortage of chips, which is a very vast, I should say, turnaround from what we saw a couple of years ago.
Yeah, absolutely. So trying to work up capacity, incredible set of circumstances, of course. Let's just look how all of that bullishness is manifested on our market today. And you can see there the CBO 200 finishing up 0.37% and not too far off the highs of the day. And let's get across the three themes and really three companies that have caught our eye. Nvidia is the first one. I mean, it's almost become a macro event, really, their results. So it tells us a lot about, obviously, AI, the chip sector, the US economy as well, the global economy too. And it does augur well for the markets going into the end of the week.
Yeah, absolutely. And Danny has written a really good piece on To the Moon about that, which we will be showing as well a little bit later on. Let's look as well at QANTAS, because this was a really interesting one, because a record profit, of course, we know travel demand is coming back, but they're not actually paying a dividend, which has kind of disappointed a few in the market. There is a share buyback, but what they're doing is rewarding their customers, their frequent flyers, with a choice of either status credits so that you can maintain your gold or platinum, whatever you are, or points. So I think that's really interesting, because I've read quite a few commentary out there that, you know, give me a dividend, I don't really want these points, that some people are having difficulty even trying to use. Yeah,
okay, so maybe trying to maybe buy back some brand equity there as well amongst those who perhaps don't own the shares but do frequent the airline. And Nine as well, we had the good fortune of speaking with the CEO a little earlier, or at least Danny did. Always interesting just to get a bit of a pulse check on the advertising landscape, the media landscape. Also a bit of a barometer of the consumer there too, I suppose. Yeah,
indeed. And she asked him about whether or not they would be trying to bid for sports as well, particularly female sports. We know that Seven did really well on the back of having the Matildas, but they did cut their 4-year dividend by 21%. So again, blaming that tough advertising market.
Yeah, indeed. Okay, so a few things to pick out there. Let's just get across, of course, well, some of the sectors of the day, shall we? And we'll start with media off the back of, naturally, the Channel 9 results. And let's see if we can get the movers up there. Nine up by about 0.5% by the end of the day's trade. News Corp and oMedia also higher. Seven West, was that? I don't know if that went ex-div today. That's a pretty big drop.
Kind of looks like a very big drop. So I think that was the reason behind that. Of course, it came through with its numbers last week. Looking at the mining space as well, we had a bit of mixed movement from the majors. BHP in the red, Rio up. Newcrest also looking pretty good. South 32 came through with its numbers today, and then Fortescue just a little weaker today, but really interesting that it's climbing back above that $21 a share level.
Yeah, always trades at a pretty significant premium, but hasn't been below $20 for a little while, even despite all these concerns around China. Worth noting there, as you did, Juliet, that Newcrest mining, the gold miners performed reasonably well today. Perhaps a little bit of an inverse play on that sort of yield story, which kind of the heat came out of that a little bit last night, and also probably supported tech stocks in the US and here as well. But let's go across the telcos, shall we? Telstra continuing to grind lower. It reported last week, I think we're both on air to wrap that day's results up as well, where we were talking about just the disappointment, I think, around asset sales. So that's still manifesting in the share price, but we can see, Nine Entertainment, News Corp, well, that's a bit of a copy and paste job actually there.
Yeah, I thought I'd put the telcos in. Anyway,
no, I think there's a back office error perhaps. But anyway, let's go to the healthcare names now as well, and that's also fairly mixed. Although it has to be said, Cochlear, after its results earlier on in the week, last week actually, in fact, still holding up pretty strong. CSL just hanging on at the bottom of the range there at about $260. ResMed in the meantime still in the wars.
And Medibank Private was a big one today as well, because it suffered that financial impact of $46.4 million due to the cyber attack that it experienced last October. So we were talking quite a bit about that company earlier as well.
Yeah, indeed. And well, we can't not speak about obviously the embattled, or maybe not so embattled Australian consumer, holding up better than expected perhaps, or at least that's what some of the companies that we've heard from so far are suggesting. And well, Lovisa is our stock of the day.
It is a television anchor's friend, I have to say. Those earrings,
Really?
pretty good price, look good on air. Let's have a look at the stock of the day.
Number came in lower than expectations, and I think it was the trading update they gave for the first 7 weeks of this year was quite a bit below expectations. So that's going to see analysts downgrading their numbers for this year and softening that outlook. And part of that is the store rollout seems to have come in a bit under, and then the sales in the new stores are coming under. So they've actually had like negative like-for-like sales growth. So I'm going to go sell on Lovisa because I think it's still it looks expensive even on what will be rebased earnings forecasts.
But cash is safety, shares are risk. So we did add some risk to this. It was the 21st, 22nd, so last couple of days, and then we got tagged today. So for people that do follow me, we know what we have to do now. There's no negotiation. It's just take our lickings and get out, because the candle that is created by today's price move is the opposite of what we want to see. So we would be what I call a zero risk position. That means we have no holding on Lovisa.
Okay, so that was Ben Clark and Carl Capelinga with their call on Lovisa there. And well, if nothing else, you don't like the stock. Apparently, earrings aren't so bad. Maybe I'll have to go out and.
They also do free piercing, Kyle. If you're
Really?
interested. Yeah.
Hey,
pay for the earrings to get a piercing for free.
Hey, if you shout it, I'll do it. I wouldn't say no. But let's get to our guest for the COB today. And Fraser McLeod from Shaw and Partners is standing by. Fraser, great to see you there. I'm not sure what your thoughts are on Lovisa as a stock or a Lovisa as a product. What's the sort of general view around Shaw's potentially? Do you like? Do you not like?
I remember the float of Lovisa, and I'll tell you a little story behind that as well. So the Lovisa is a high margin business. So just take that into account when you're buying the jewelry at what you think is a cheap price. It's very popular amongst the youth of Australia. It's popular because they regard it as almost disposable items, and I would say that the anchors of your show are probably worth an awful lot more. I sort of imagined you just wearing Gucci and that was it. But as long as the management just keep that one in mind and don't broadcast too much. I remember this a story from about 30 years ago. There was a very large chain listed on the AIM market in London. They were really the biggest jewellery retailer in the UK. And if you Google doing a Ratner, they were called Ratners, and Gerald Ratner used to, he was the managing director of the business. And he stood up one day in front of the cameras at what he thought was a private gathering, and he basically said that the quality of the goods that we were selling was not very good at all. He used a pretty descriptive term, and after that the share price bombed and never recovered, and they had to rename the business. So just keep that in mind with Lovisa. They make huge margins, and you don't have to pay a big price on it at the very beginning. So, but very popular amongst the youth, and it's in a market that in the high street where people are watching the pennies that they spend. Look, they'll probably continues to do okay. Always interesting to around Christmas time to look at the shopping bag index as well, and just the people that count the level of the numbers of shopping bags that go past them. They always do quite well, because you can tell what people are truly buying.
Yeah, it is for the fun stuff. I remember getting some Santa earrings for Lovisa. You're not going to spend millions on those, are you? Let's get more to...
Certainly not.
Let's get to BHP. CapEx is back, you say. Why should we be looking more closely at BHP?
Look, I'm pointing out BHP because this week, obviously, everyone knew that revenue was going to be down, and pretty much in line, the revenue was down, so that costs are up and CapEx is back was really the two themes that we took away from it. And that the big change there is that they're moving away from the culture that we all have got used to over the past few years, which was, we're not really going to invest in CapEx. What we're going to do is we're going to keep our shareholders happy, and we're just going to keep giving them that sugar rush because we're making lots of money, and here, have some money back. Here's a higher dividend, and here's lots of buybacks that we're going to be doing, and here's just cash here, return the cash to shareholders because we don't have a better place to put it. That is changing. They've now. Probably the dividend was a bit shorter than where people had expected, and $1 billion of capex is BHP committing to growth again. So we like them for that. I mean, that needs to be done. It cannot go on forever that BHP and large mining companies around the world are underinvesting in what needs to be future demand. It's sensible. The question really is for BHP is over. Well, what do you like the most about them, and what do you dislike the most about them, and how do you balance that out? And it really just comes down to two commodities. If you like copper so much, then you'll put up with the iron ore. But if you dislike iron ore so much, you probably the copper side of the business just won't swing it for you. It's more difficult these days in order to get a single name exposure after BHP has bought Oz Minerals. So difficult for copper investors to get that clean exposure. You'd probably still keep them if you were happy and believe that the copper is the future, which it is. But we need to be very, very cautious on iron ore because at current prices, the free cash flow yield on BHP for iron ore, current prices of iron ore, is about 6%. If iron ore goes to $85 a ton, then they're on a 4% free cash flow yield, and it's looking a bit ugly. So one to watch out for, a good change of culture, but you need the iron ore price to do okay from here.
The supermarkets, we had both of them report this week, and perhaps a little bit of, I think, what shrinkflation might be back to some extent. Do you have a preference one over the other? And what are they doing to us? Giving us less for more, perhaps?
I don't know, giving us less for more, but what certainly is happening. In theory, supermarkets should be a pretty safe place at this stage of the cycle within the economy. So their costs going up, they can usually pass across, and so inflation isn't a huge problem for these non-discretionary retailers, especially on a supermarket level. Woolworths we prefer because and are happy to pay that extra, say, 4 PE points for. So it is a more expensive stock, but they've invested for the future a lot better than Coles have over the past 5 years or so. So they've got the digital platforms right. If you go into a new Woolworths store these days, the actual pricing of the items is electronic. They don't have people going around and placing these little paper tickets on items anymore. It's a much more efficient operation. Bizarrely, whilst costs are going up and labour has been a challenge really across the board for these supermarkets. Bizarrely, the real shrinkage problem, and which is basically theft or even organised gangs and coming and stealing, because the police are not going to get there in time. There is a culture nowadays of organised crime going in and just ripping these supermarkets off. That's a big challenge. The numbers were absolutely huge, and it's affecting the bottom line at Coles, probably less so within Woolworths. So Woolworths better digital. Certainly costs are going up, but they're able to pass the costs across. And so Woolworths is just that little bit better all round. Stick to the Woolies, and probably no need to be holding both within portfolio. So I'd say no on the Coles and yes to Woolies.
All right, let's go back to the mining space. Of course, in terms of Paladin, it's reporting earnings, I think, tomorrow. But what are you looking at there, Fraser?
Yeah, so earnings won't be the big call there. There is no earnings. The Langer Heinrich mine is there, but it hasn't been switched on as of yet. So they're bringing it back online. The reason why Paladin is going up, and it's up more than 60% over the course of the last couple of months. So we're falling in love again. Many investors are with the stock, and it's been a darling of Shawn Partners really for quite some time over the past couple of years. The supply is becoming an awful lot less certain, and demand is becoming an awful lot more certain within the uranium environment. There's a couple of reasons that basically behind that. One of them is the decarbonization story, and uranium certainly has to, and nuclear power has to play a part in that globally. That's without a doubt. But the other reason is just the ESG push. So it is seen as being a clean energy and a cheap energy as well, and a very safe and reliable energy. So politically, we're probably going to be, it's going to take us a bit longer to even accept it within this country here in Australia. But that doesn't really matter at all from an investor's point of view. The other interesting stock to look at would be NextGen. Now, they've got a secondary listing now here on the ASX, but their main listing is in Canada and also in the US market. They're building an enormous mine. They hopefully will get the environmental approval and all that to build the enormous mine out in Saskatchewan. And their costs are going to be very, very low. There's the potential once they build that mine that there's an 11-month payback on their capital spend, which I haven't seen for, I don't think, ever before. So, two really amazing stocks that in what could be quite a dynamic market. It looks as if an awful lot is going right within that space again after probably a pretty neutral year over the course of the last 12 months.
Yeah, one imagines massive upside in that space if, perhaps the, legislative and political environment changes in different parts of the world. But Fraser, really appreciate getting you on today. Thank you so much for your insights, Fraser McLeod from Shaw & Partners.
Good old pleasure. Thanks.
Okie dokie. Let's take a look at the leaders and laggards, shall we? Starting off with the leaders. The good news, of course, Wisetech bouncing back after yesterday's rinsing that it took after its results. Nothing can grow to the sky, of course, Juliet. But looking across the board, some gold names there. Life360 also bouncing back as well.
Yeah, that's an impressive near 5% gain there. And how do you say that one? That's
Good question.
That's a new one since I've come back to Australia. I don't know that stock, but up 4.6%. I'll go do some homework in a minute.
Yeah.
Let's look at the laggards there as well. Ramsay Health. Look, this was another one that did come through with some earnings. I think that was a little bit of a disappointment there. Insignia Financial, I was talking on the small caps there to the CEO, and that seemed to be the fact that the dividend was a bit of a disappointment. Perpetual also under pressure, and then of course Lovisa, we were talking about our stock of the day, down by 6.4% today.
Indeed, and Ramsay Healthcare cut its dividend by half, so pretty brutal there. Also, Costa Group, disappointing results, and a lot of investors concerned there that it might throw this acquisition into some doubt. So it's trading at about $3.30 there. Leading into this result, a bit of a discount being baked in, at least for the time being, as we work out whether, it might shake the nerves of that private equity company looking to, we'll take that off our market. But let's get across the leaders and laggards. In the small cap space now, Mesoblast, a perennial mover at that end of the market, up by a further 17%. And for those, for investors in that company, a very strong week indeed. An assortment of names there, it has to be said, but let's look at the laggards in the small cap space. And pulling back after what was a 96% rally yesterday is 4DS Memory. Tried to get across that news. It was just seemed to be a very positive response to some results there, so just volatile.
I don't think you continue to go up after a gain of that, do you?
You don't double every day, no.
A little bit of profit taking, shall we say. Tambourine down 7%, PYC Therapeutics off 6.5%. Let's have a look at what we are going to be seeing in the US session. Jobless claims data, always a really important prediction of how the market is going, what the Fed could be thinking going into Jackson Hole, and also durable goods orders, which is a really good pulse check of the overall economy as well. Yeah,
and even just to get a bit of a pulse check on one segment of the US consumer, Dollar Tree will also be fascinating. We'll wake up to that tomorrow morning, probably a little less eventful than this morning after Nvidia's results, but nevertheless, still US earnings season rolls on. Of course, it never seems to end. Let's go to what we are looking forward to tomorrow. And, of course, it's the last call.
My very first last call. I'm excited about that.
Yes, and you're saying that, perhaps a nice novelty, being able to have a drink on air.
Yeah, certainly. Never have done that in my life. It's the first for everything, isn't there? But we're also going to be talking to the Wesfarmers CEO, Rob Scott, so that's going to be really interesting when it comes through with its earnings tomorrow. And we're talking to Fraser there about Paladin. It's coming out with its numbers. Linus also in the metal space, and Main Pharma in the healthcare space, among the other companies reporting tomorrow.
Yeah, so we're well and truly through the halfway point of this earnings season now. Another, what do we call it, a Super Thursday behind us today. So hopefully it's kind of downhill skiing here. But if anything, if this reporting period up to this point is anything to go by, there's going to be some big hits and big misses tomorrow. And onto next week as well. But I digress just a little bit. We'll wrap it up there. Remember, you can catch up on all the news and interviews and Everything else you need to know on our website and app. Otherwise, have a lovely evening, and we'll see you tomorrow morning.
See you.